here to speak with us. Manishi, always great chatting with you. Give us a sense on whether you're turning positive, constructive, especially with regard to India. That FII outflow number just seems to be keeping a lid with regard to what Indian markets can do. But the DII inflows have been extremely strong. For how long can this continue, in your opinion?
Thank you. Thank you, Harsh, for having me here.
Great having you.
The phenomenon that you mentioned, that FIIs are selling, and they have been selling for the last 18 months, roughly. And the domestic institutions buying, that's not something new. I mean, we have seen this for last 18 to 24 months. The spate of FII selling has been neutralized by this massive systematic investment plans, the SIPs, that continue to come in, almost about $3 billion every month. I think it says two things about India. Number one, the foreign investors have a large firmament, a large universe to choose from. And compared to India, they have better choices elsewhere in the emerging market space. They have far cheaper North Asian markets where the themes like artificial intelligence and particularly AI capex and supporting AI infrastructure, that theme is still very much alive. Second, some of the North Asian markets like Greater China, they're relatively immune to this recent conflict situation and the oil price spike because of the much larger reserves that China has. So it's a combination of stronger growth and slightly lower risk that the FIIs are playing. On the other hand, the domestic institutional investors who are getting huge inflows, this is a direct consequence of the financialization that we have seen. It's not recent, it's been there for about last 5 to 7 years. And I think this is something that's likely to continue, that even after this large spate of DII investments and SIPs, Indians are on an average still underinvested in equities. Now, what may happen going forward, of course, is that Indians may want to diversify their holdings, not just in Indian equities, but also in overseas equities. We know of many investment banks, many fund managers who are making such opportunities available for Indians. So, but largely, maybe it's still about 85, 90, 95% of Indian investments would remain focused on the home markets. So this is something, at least for the time being, we're likely to continue to see.
Right. Interesting. So Manishi, when you talk about India specifically, because Indian retail investors here don't have much of a choice, would you say that the decline has been ripe enough and one can look at buying right now, given that valuation comfort seems to be getting there, especially in specific pockets?
That's an interesting point. If you look at the relative premium that India enjoys compared to Asia ex-Japan, at the peak in September 24, India's price earnings multiple, 12-month forward price earnings multiple, was 87% higher. It was stupendously high compared to Asia ex-Japan. The last 15 years average is about 38, 39%. And today, India's premium has actually come down below that level. I think the latest reading is about 35 to 36%. So relative to the Asian universe, it is again beginning to present an interesting opportunity. Now, is this enough to entice the fund managers to buy into India? To some extent it is, because we are seeing positive commentary about India from some of the FIIs. But the FI universe as a whole is not biting into this yet, simply because the earnings environment is not yet supportive. We have seen, and we have written at length about this, if you look at last 6 months, about the 2026 consensus EPS of the different countries, you have Korea right on top, which is about 80% upgrade to their consensus EPS numbers. You have Taiwan following close on the heels with about 20, 25%. You have even some of the ASEAN markets like Malaysia, where the consensus EPS estimate has increased. But the Indian consensus EPS estimate still remains, it has still declined over the past 6 months by about 4.5% or so. So the FIIs will possibly come back in a more significant manner once they have a bit more comfort about the earnings environment.
Manishi, hi, morning. If that is the case, then you're looking at almost washout FY 26 numbers and 27 numbers, and maybe marginal increase in FY 28 numbers, given the kind of uncertainty we have on crude and the impact that going to be there on the earnings.
Right. So, that is certainly a valid concern. You have fiscal 27, which actually needs to shape up, as far as, the earnings environment is concerned. We have not yet seen any significant sign of that. At some point, this large fiscal stimulus that went in 2025 through both indirect taxes reduction and direct tax reduction, it'll begin to have some effect. It did have some effect on the on the auto consumer discretionary buying during late 2025, but it needs to be more sustained. I think, even monetary stimulus, I think the central bank can perhaps afford to cut rates a little more. We, of course, have to go beyond this present environment of inflation scare that we are seeing. If we do have a situation where the Middle East situation settles down, and therefore we have oil prices coming back, maybe not all the way, but to a significant degree, somewhere close to that 60 to 70 per barrel range, we could have this concern about earnings destruction behind us. So that is some kind of a best case scenario of India. Whether it would pan out or what duration it would take, what time frame it would take to pan out is the big question.
If you look at Manishi, the P multiples for India, there have for the longest time we're trying to come to a base where the P gets derated to a sustainable level so that FIs can come in, and the DI flows are holding off the P at this point in time. Do you think 17-18 times forward earnings is the nominal P that Indian markets will trade at, and the rest would be dependent on what earnings are going to do?
Yeah. Now, again, this is something that we debate all the time. If you look at last 15 years, average 1 year forward PE for India, it's about 18.8 times. Right. Now, of course, Indian earnings growth have fluctuated quite significantly during that time frame. If you look at calendar 24 or calendar 25 in particular, EPS growth for India was in single digits. Now, obviously, if it remains in single digits, then those high teens kind of PE are unsustainable. At some point of time, investors would say that, okay, I can't pay this valuation for this kind of earnings growth. So, until and unless we have the usual, I'm searching for the right word here, the usual linkage to nominal GDP growth, that is nominal GDP growth of about 10 to 12%, and therefore corporate revenue and earnings growth of 13 to 14%. Unless we get back to that situation, it will be difficult for these long-range P multiples to hold on. Now, of course, I mean, if nominal GDP growth, earnings growth, if they do go back, if they do mean revert, then we will possibly have P multiples also sustaining at those levels. And that, I think, is kind of a long-term outlook that many investors would want to have at this point of time.
Okay. Manishi, if one were to keep that long-term outlook, and there's a very interesting Morgan Stanley note which I was reading yesterday, that valuations look oversold where India is concerned. If one were to, or if you're of a very similar kind of opinion, if one were to start nibbling at this point, what is it that you're finding attractive and interesting? Give us a sense of that. I know you're positive with regard to banks, for example, but outside of that, what is it that one should start nibbling onto?
Absolutely. Great question. So, you rightly pointed out private banks, and I've been kind of thumping the table on this for quite some time. I would also be looking at industrials, including defense companies. Now, the kind of geopolitical environment that we are in, defense expenditure is likely to rise stratospherically across the world, and we're already seeing that in Europe. Much of those orders would also come to the Asian companies, and we're seeing that in a big way in Korea, by the way. Industrials would also, cater to India's infrastructural ambitions. At some point of time, rebuilding Middle East would become a priority. I would also be looking at consumer discretionaries in India, and this is quite a wide range. I would be looking at the auto companies. I would be looking at, the household electronics goods. I would be looking at even some of the, the hospital and diagnostic chains, which I kind of clubbed with the consumer discretionaries over there. So these are some of the, pockets that investors should play over the long term. I think in the near term, some of the cyclical sectors like base metals could also do well.
Interesting. Manishi, I noticed that there is no IT in your preferred list, consciously staying away.
I have been, as I've told you even earlier, in my interactions, that I have stayed away from Indian IT for, it's been almost a year now. And Indian IT, well, they are the classic AI losers, and what may happen is that even though enterprise software would still remain embedded in the large companies, the companies would actually ask for some kind of a differentiated man-hour rate after incorporating AI agents into the service that these Indian IT companies provide. We are already seeing that. Yeah. So, what would happen, therefore, is the average man-hour rate comes down, and therefore the valuations of the IT companies come down. The consensus EPS growth for them is in single digits, about 6-7%. They're trading at about 18 to 20 times P, simply not sustainable.
Okay. Manishi, thank you so much for coming in and speaking with us. This gives us a great perspective on what to look at, what not to look at, and how you're looking at the investing universe. So thanks so much for coming in. Let me, in fact, quickly highlight plenty of movers in this market. Let's